Do you need a perfect credit score to get a loan? Big banks don't want you to know this. Ever dreamed of buying a house, starting a business, or even getting a new car? Well, chances are you'll need a loan to make it happen. But the loan application process can feel like a total mystery, shrouded in confusing terms and credit score anxieties. So, let's talk about one of the biggest questions borrowers have. Do lenders use your Transunion score exclusively when making loan decisions? The answer might surprise you. Understanding the credit score landscape. First, a quick credit score 101. There are actually three major credit bureaus in the United States: Experian, Equifax, and Transunion. Each bureau collects information about your borrowing habits and creates a credit report for you. This report includes details like your payment history, credit utilization, the amount of credit you're using compared to your limit, credit inquiries, and the types of credit you have, credit cards, mortgages, etc. Based on this information, each bureau generates its own credit score for you. These scores can vary slightly between bureaus, but they all generally fall within a range of 300 to 850. A higher score indicates a lower credit risk, meaning you're more likely to repay a loan on time. Why Transunion matters, but isn't everything. Now, back to the question of lenders and Transunion scores. The truth is, lenders do heavily consider your credit score when evaluating your loan application. Transunion, along with Experian and Equifax, are the go-to sources for this information. However, it's important to remember that your Transunion score is just one piece of the puzzle. Here's why. Lenders use multiple bureaus. Many lenders pull reports from all three bureaus to get a more complete picture of your creditworthiness. This helps them identify any discrepancies or errors that might be present in a single report. The score is just a starting point. While your credit score is a crucial factor, lenders also consider other aspects of your financial situation. This includes your income, employment history, debt-to-income ratio, DTI, and the type of loan you're applying for. Alternative data is on the rise. Some lenders are increasingly looking beyond traditional credit scores and incorporating alternative data points into their decision-making process. This could include your rental history, utility payments, or even your bank account information, with your permission, of course. So, what does this mean for you? This means you don't need to be obsessed with having a perfect Transunion score, although maintaining good credit is always a good idea. Here are some key takeaways. Focus on building a strong overall credit profile, aim for on-time payments, keep your credit utilization low, and avoid unnecessary credit inquiries. Check your reports regularly, get free copies of your credit reports from each bureau annually, and dispute any errors you find. This ensures all three bureaus have accurate information about you. Consider alternative loan options. If your traditional credit scores aren't where you'd like them to be, explore alternative lenders who might consider your full financial picture. Remember, knowledge is power. By understanding how lenders use credit scores and the broader loan application process, you can approach your borrowing needs with confidence. With that said, thanks for watching, and until next time.